In this video, we'll discuss all the benefits that the C Corp has to offer. But before we get started, please make sure to like, subscribe, and turn on that notification bell. So to start off, what is a C Corporation? Well, it's a business entity that faces two levels of taxation. One is at the entity level, and the other is at the individual level. So how does this double taxation work? Well, if the business generates any earnings in the year, those earnings stay inside the C Corp, and those earnings are taxed at the corporate tax rate of 21%. And if the entity pays any dividends to its shareholders, those shareholders are taxed on those dividends at their individual tax rate. And this individual tax rate can be as high as 37%. And it's worth noting that both corporations and LLCs can elect to be taxed as a C Corp. Now, if you use a C Corporation, what are the C Corp benefits? Well, the first benefit is if you want to go public. If you have a corporation and you want it to go public to be registered on a public stock exchange, the SEC requires that entity to be taxed as a C Corporation. The second benefit is that C Corps have fewer ownership restrictions. This is unlike the S Corp, where all owners of the S Corp must be U.S. citizens. But in a C Corp, its owners can be both entities and foreigners. The third benefit is that the C Corp can issue multiple classes of stock. And the two most common types of stock are common stock and preferred stock. So common stock is stock that gives shareholders voting rights, but those shareholders do not have a priority to receive dividends from the corporation. And the second type of stock is preferred stock. Now, preferred stock may not permit voting rights, but its stockholders have a right to receive company dividends before common stockholders do. And in addition to this, C Corps can issue other classes of stock as well. The fourth benefit is the C Corp's ability to raise capital. And this is because C Corps can issue different types of stock to different types of investors. And these investors can be venture capital firms, private equity firms, institutional investors, or even angel investors. And this comes in handy because it allows different stockholders to receive different voting and economic rights. The fifth benefit is that the C Corp allows for certain tax deductions that other entities don't. And this is because the C Corp can deduct the following items to reduce the entity's taxable income. These things include salaries and bonuses, medical premiums and fringe benefits, as well as certain charitable contributions. But you're definitely going to want to check with your CPA ahead of time. The sixth benefit of using a C Corp is the potential to have the qualified small business stock exclusion. This is also known as QSBS stock or Section 1202 stock. So here's how this works. If you buy stock in a C Corp and hold on to it for 5 years, and then eventually you sell it at a higher price, you can reduce your capital gains bill by taking advantage of the QSBS Section 1202 exclusion. And this exclusion amount is the greater of either $10 million or 10 times what you paid for the stock. And if you hold stock in a C Corp, you're going to want to double check with your CPA to see if you qualify for the QSBS exclusion. Now, with the advantages out of the way, what are the disadvantages of using a C Corp? Well, the main one is the fact that the C Corp is subject to double taxation. And this is unlike an S Corp, which is only subject to one level of taxation at the individual level. And the reason it's double taxed is that the C Corp faces one tax at the entity level and a second tax at the individual level if any dividends are paid out. And with the single taxation, all the business profits flow on to the individual owner's tax return. So in that case, with an S Corp, the tax is only at the individual level, and there's no corporate level tax like there is with a C Corp. And this is why entity selection is really important, because if you choose improperly, you could be subject to adverse tax consequences. And this is why C Corps are not right in most situations. The second disadvantage is that C Corps can be more costly to form. In many states, the cost to form a corporation is more pricey than the cost to form an LLC. And the third disadvantage is that there are additional formalities associated with the C Corp. And this is because C Corps have two governing bodies. The first is the board of directors, who provides oversight for the corporation. And the second governing body is the officers, who are responsible for carrying out the day-to-day operations of the corporation. And with a corporation, you're required to have annual meetings, as well as having additional documentation on hand, including your bylaws. And on top of this, the Secretary of State may require you to file an annual report every year. So in conclusion, C Corps can come in handy when you want to take a company public, or you want to take advantage of some of the benefits that they offer when it comes to tax write-offs. But in most other situations, forming an LLC is ideal. And regardless of whether you want to form a C Corp or an LLC, my company Corporate Direct can help you do both. You can schedule a free 15-minute consultation with one of our incorporating specialists by clicking the link in the description below. And if you mention that Ted sent you from YouTube, you get $100 off your formation price.